Hi there, welcome to Kneppy Invest and welcome to another article reaction video. This one is from Livewire's Buy, Hold, Sell series. The article titled Hunting for Quality in ASX Small and Mid Caps and for Cracking Picks. Now, typically in this series, there is a moderator, and I think in this case it's Anna something, and the two experts are from Airlie Funds Management, Will Granger and Mark Whitaker from IML. Now, what I'm going to do is separate this video into two parts. The first part will be focusing on the whole reason why I've decided to do a reaction to this video, and that is because both of these experts were asked to define the term quality. And I think that's very important because I don't think there is one all-encompassing definition of quality. As individual investors, we need to define quality or what quality means to us. So what is a quality company is very important. So what I'm going to do is go through how both of these experts define quality, also define what I mean by quality. And another question they'll ask is, what are some of the characteristics that they are looking for in individual companies? Now, the second part of this video will be focusing on the 4 cracking picks. So I'll probably release that video 24 hours after the first video. And I think there's a pretty good debate whether these 4 picks could be considered cracking, unless they're talking about cracking eggs. Anyway, so let's get into the crux of this particular video, focusing on the term quality, because it is fairly important. In fact, it's very important for me, because when I'm looking at a company, the first thing I am trying to discover or decipher or figure out is whether a company is high quality or low quality, or where it fits on the quality spectrum. Because some companies can be almost high quality, but not quite there yet. Some companies have the potential to be high quality. They might be going up the spectrum, that sort of thing. So that is the very first thing I'm trying to figure out when I research a company. So I do have some things I'm looking for. And what I'll do before I have a look and discuss the things that Will Granger and Mark Whitaker are looking for, I'll discuss what I am looking for when it comes to high quality companies. The first thing I always look for is growth. So we're talking about revenue growth. Now, typically, if a company is growing their revenue at a pretty good rate, that should translate to increasing earnings per share. Doesn't always happen. So the first thing I always look at is revenue growth. Now, some people might say, why not just look at earnings per share growth? Well, the reason I do have a look at revenue growth first is because that's at the top of the profit and loss statement. As you go further down and down and down the profit and loss statement, there's more manipulation going on. There's way less manipulation when you're talking about revenue. So if I see revenue growing continually over time, that is a good thing. Now, preferably, I like to look at revenue per share growth, because a company can grow their revenue without increasing their earnings because of acquisitions. And the main reason they can do that is they can increase their revenue and increase their shares on issue at a greater rate, which would not be beneficial for shareholders. So first thing I look at is revenue growth, preferably revenue per share growth. And then I have a look at margins, focusing on gross and operating margins. Also have a look at how margins are changing over time, which I do believe is important. Now, one of the reasons I look at margins, particularly gross margins initially, is because that can give you a clue, particularly if it's changing over time, on the moat or competitive advantage, sustainable competitive advantage of a company. So that typically is the second thing I look at. And then I focus on some efficiency metrics, or what I define as quality metrics. So that could be a bit of a giveaway. And those are return on equity, return on invested capital. Now, I do prefer return on invested capital for a few reasons, but return on equity is much easier to calculate when you're just going through a company's financial statements. Return on invested capital is a little bit harder. Now, a lot of platforms will give you both. They should give you both. But if I had the choice between the two, I'd focus on return on invested capital. But you can get a pretty good idea about how a company is efficient, really efficient, at creating wealth for the shareholders just by looking at return on equity and return on invested capital, particularly over a longer period of time. And typically what I look for is above 10 for both. And if you do see return on equity, return on invested capital above 10, there is a chance that this company is a high quality company. Now, sometimes a company that has return on equity or return on invested capital above 10, they will have a dividend payout about 100% or between 75 and 100%. And that means most of the profit is going back to shareholders. So in that sort of instance, I would actually not define that company as high quality. I'd probably define that company as quasi high quality because there's less chance that company is going to be growing over time because they're giving all their cash flow or their profit back to the shareholder as dividends. And that's not the recipe for growth. So some of the other things I also look at. So all those things I've just mentioned are quantitative. You can see that just by looking at the financial statements. Some of the other things that I do look at are more subjective. We're talking about management, the quality of management, and there's going to be some management teams that some people like, some people don't like. Also the moat. Now, moat can be quite subjective at times, and I do tend to focus on looking at gross margins, return on invested capital, return on equity when it comes to moat. And sometimes you just know a company has a moat, like Coca-Cola, that has a brand moat, that sort of thing. So those are the sort of things I am looking at when I am trying to figure out whether a company might be high or low quality. Now let's have a look at how Will Granger and Mark Whitaker define quality. Now, when I went through this article this morning, that was actually the first thought, because I saw the title of this particular article, Hunting for Quality in ASX Small and Mid Caps. And I was thinking to myself, well, how are they going to define the word quality if they do define the word quality? And I was quite skeptical as I started reading this that they actually would define the term quality, but lo and behold, they did. In fact, in the first part of the interview, Anna, the moderator, says, let's dive right in. Will, let's start with you. How do you define quality? And as soon as I saw that question, I knew I was going to like this question because I do like to have a look at how other people define the word quality. Now, sometimes we're quite similar, how I define quality and someone else, but sometimes we're a little bit apart. Very rarely are we light years apart that I do have to think, well, maybe they are right or maybe they're wrong, and maybe I should rethink how I define the word quality. Okay, so Will Granger mentions durable competitive advantage, and that is another term for moat. Durable competitive advantage is a moat. So you could use the word sustainable competitive advantage, but the same thing. So first thing he looks for, or Airlie Funds looks for, is a moat. The second thing they look for is growing at attractive rates on incremental capital. And as soon as I saw that, I instantly knew he was talking about return on invested capital. So moat, return on invested capital, or growing at attractive rates. And again, we've got the word there, growth. Growth is very important, in my opinion, when it comes to quality companies. Okay, now on to Mark Whitaker, and he echoed Will's points on competitive advantage. And that is a common theme when you read, listen, hear, watch anyone talking about quality. You always see the term moat or competitive advantage. That is the one common theme. And a lot of times you also hear the words or see the words return on equity, return on invested capital. Those tend to be fairly common among the experts when it comes to quality. Okay. I was going to say also, okay, I've just combined the two words there. Okay, so Mr. Whitaker, Mark Whitaker, also mentions competitive advantage. Also, he says resiliency of earnings. I actually did some notes here, and I just put there predictability. Predictability. So he's talking about recurring revenues. And recurring revenues is very good for companies because they have this predictability. They're able to plan ahead because they know exactly how much cash flow might be coming in a period of time because it's recurring revenues. And the reason I was thinking about that is because I was listening to how Adobe went from their previous old model to non-recurring revenues to recurring revenues in a fairly short period of time. When they made that transition, the company suffered when it came to cash flow, that sort of thing. But recurring revenue is very helpful for individual companies because they can plan ahead. So I'm not sure if I would put that into my definition of quality companies. But that's just difference of opinions there. So Mr. Whitaker and whatever fund he's working with, what was it? what was it again? IML. Just a slight different opinions. Okay, but something else he mentions here is growing earnings. So he mentions we're after companies that can steadily build earnings over time. Growth, 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 growth. Again, growth is important. He also mentions management as being important, something that's more subjective, but he's also pointing out that management is more important when it comes to small cap companies. And he tried to maybe make the CEO of Telstra and Combank turn against him because he says in large caps, you could argue, CEOs may disagree, but if you're running Telstra or Combank, day-to-day decisions don't just drastically change a company's trajectory. And I sort of believe in that. So again, I do believe management is important, but that can be subjective at times. Okay. Now, there's another question that Anna does ask both of these experts, talking about when markets are volatile, everyone pivots to quality. I won't discuss that, but what I want to discuss next is the question, what are the key characteristics you look for when investing in a quality stock? So they do actually mention some things that I also look for. So for instance, Will mentions owner, founder, led, and that is something I do look for. In fact, if I do see a founder-led business over a non-founder-led business, I will gravitate towards a founder-led business. He mentions here that founder-led businesses often take a long-term view and are shareholder-friendly in their capital allocation. Now, that's important because in my opinion, capital allocation is the most important job of management when a company becomes profitable. What are we going to do with the cash flow or our profits? Are we going to continue to grow the company, or are we going to give all this profit back to the shareholders as dividends? That's really important. In my opinion, again, it's the most important job of management, and it can change the trajectory of a company if they drastically change the way they deal with capital allocation. He also mentions they like businesses with strong balance sheets. Now, he doesn't actually mention how he defines strong balance sheets, so I'm assuming he's talking about a fairly low debt to equity, and that's probably a wise assumption because me too, I like strong balance sheets, particularly companies who have low debt. He also mentions, of course, valuation is always a key factor. So you can't be talking about a high quality company, but it could be priced at absolute perfection, and you might not get a good return out of that company. You might not get a return for 10, 15, 20 years. It has happened in the past. It will happen in the future that people will overpay for quality. So valuation is always a key factor, whether or not a high quality company is a buy or not. Now, Anna moves on to Mr. Whitaker, who agrees with Will on all of those, but he also adds resiliency of end demand, which was really interesting. Didn't really expect this. And he's talking about elasticity of demand. In fact, he mentions here, we look closely at elasticity of demand, how sensitive customers are to price or market conditions. In a way, this is looking at non-cyclical companies or defensive companies. So straight away, my mind turns to Woolworths. So Woolworths are selling mostly food, not all food, but mostly food. And those tend to be, well, some foods tend to be highly price inelastic. So if the price of milk goes up a lot, more than likely you won't see the demand of milk go down or that much because a lot of people rely on milk or bread. Those sort of staples that people do rely on, those are less sensitive to price changes. So seems like Mr. Whitaker and his team are looking for defensive companies. And in his opinion, defensive companies are quality. I could disagree with him on that. Okay, so that is a look at how Mr. Whitaker and Mr. Granger, did I get that one right? Yep, Granger, define the word quality and what sort of characteristics they are looking for in a company to hold, to own in their portfolio or portfolios. Okay, so I'd love to hear your thoughts on quality. What is your definition of quality and what are the characteristics you're looking for? And then in tomorrow's edition, I'm going to go through the 4 companies they have listed: Regis Healthcare, Gentrack Group, News Corp, and Reliance Worldwide, because I do have a little bit of disagreement with these 4 picks. So join me then in 24 hours. Well, all depends on when you're watching this video. It could be like 1 hour from now, but on Tuesday, the May 13th, I will release that second part of this video. Okay, that's all for this video. Have a good day. And don't forget, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.